Hey there, welcome back to another episode of Making Sense of Your Markets. Today is Saturday, it's May 7th, 2022. Every single week, I share three simple strategies with you. I talk about mortgage interest rates. Are they up or down week over week? Number two, I give you a tip, a money, a mortgage, a real estate investing tip that you can use to save money. I've got a really good one, a relevant one to share with you today. We're going to talk about 2-1 buy downs and permanent interest rate buy downs. And then lastly, I always share a mindset tip. We are on week 42 of our 52-week series from the best-selling self-improvement book, The 7 Habits of Highly Effective People. This week, we only have 10 weeks left. We are going to talk about valuing differences. Crazy great lesson. It's 2 sentences. We always wrap up 30 seconds at the very end with this mindset tip. So week over week, our mortgage interest rates up. The Fed spoke this week. The Fed raised the Fed funds rate. Not mortgage rates, the Fed funds rate, and mortgage rates dropped as a result. And then the next day, employment news came out and we lost all of our gains. So week over week, interest rates are up. Again, we have now crested the 5.5% 30-year fixed rate mark. Depending on your credit score and down payment and type of property, rates are going up every single week for the last probably 15 weeks. I've been talking about rates going up. They definitely are. Still a great time to buy. Still, the housing market is still very competitive. It's not really flinching. I've gone on record and said this. I think when we get over 6%, it's going to shock the housing market. It's going to shock some people from an affordability standpoint. We'll see it slow. But right now, we're seeing it soften a little, meaning there's not 10 or 15 offers on houses. There's still 3, 4, 5. Still very competitive because there's a lack of inventory. So still a great time to finance a house. Don't sideline yourself because rates are going up. What goes up must come down. I believe in the next 12 to 18 months, rates will come down. And when rates come down, homeowners get a chance to refinance. So go get in the game. It's a great time to get in the game, buy real estate. If you have any questions around that, please reach out. I'd love to be a resource. So this week I want to talk about a 2-1 buy down, a permanent buy down, and if it's worth it. So I want to give you kind of an overview. What is it? A 2-1 buy down is where you take a note rate, a going 30-year fixed rate like 5.5%, for example. You apply credits that you get from the seller or from a builder, and you use those credits to deploy a 2-1 buy down strategy. So for year one, your interest rate, you minus 2% from the interest rate. So instead of 5.5% for year one, it's 3.5%. Fully amortized, so your payment drops substantially. Year 2, it drops down to 4% instead of 5.5, and then year 3 to year 30, you pay the 5.5% note rate. So you get some savings out the gate. A lot of people traditionally have used that program to market low rates. I don't like it because it's deceiving. What I like to use is a different strategy. This is called a permanent interest rate buy down. The permanent interest rate buy down is where you take the note rate, 5.5%, you apply the same credits, approximately 3% from the seller or from the builder. You apply those credits to buy down using discount points to buy down the interest rate permanently. So it doesn't drop for a couple of years, then go back up. Instead of 5.5%, for example, you get 4.875% for the life of the loan. Let's compare and contrast the two. Over a 5-year period for a 2-1 buy down versus a permanent interest rate buy down, the savings on interest are about the same, about $24,000 in savings of interest over the first 5 years. Over the first 2 years, a 2-1 buy down might make sense. So if you think you're only going to be in the house for 1 to 3 years, a 2-1 buy down might make sense. Think you're going to be in the house 3 to 5 years or longer, I would side with the advantage toward the permanent interest rate buy down. Now, here's the catch. There's a program out there that I believe is a win-win for buyers and for sellers, and it's the permanent interest rate buy down program. And I say that because if you were to drop the purchase price to accommodate that savings from a monthly payment, instead of doing a permanent interest rate buy down, you as a builder, you as a real estate agent, seller, you would have to drop the purchase price, for example, right here on a $900,000 purchase, you'd have to drop the purchase price all the way to $845,000 just to save from a monthly payment standpoint the way you would save on a permanent interest rate buy down or a 2-1 buy down. Now, I don't like seeing that because traditionally when markets get tough, Real estate agents and sellers, if their listings don't sell, real estate agents, and builders, they just drop the price. We don't want to see you dropping the price. Instead of dropping the price by $55,000, deploy a 3% seller credit. You only have to apply $27,000 to buy down the interest rate to see the same exact savings. You want more information on this? Down below the video, you'll see the mortgage planning report that I put together on this and some more information. Just reach out to me as well if you have any questions. Well, we're entering a transitioning market, and I believe in markets like this, your strategy matters more than ever. I've been here before. I've been in your shoes before. I've had experience in these markets. Reach out to me if you have any questions. I'm happy to help. Have a great weekend. We'll see you next Friday with another update.